So Ariah Klages-Mundt is a PhD student in applied math at Cornell whose work focuses on stablecoins, DeFi design, applied math, complex systems, and network cascades. So today's talk is entitled The Unreasonable Design of Stablecoins. Ariah, take it away.
Thanks for the intro. So the past year has seen many new types of stablecoins entering the ranks. On the custodial side, we've seen some of the more niche categories that we predicted kind of before emerging. For instance, recently hearing about Tether and USDC really being more of like money market funds. And on the non-custodial side, we see sort of like a broad range of new categories, or at least examples of new categories emerging along a number of different dimensions, which we'll talk about a little bit further in a second. But how have these stablecoins fared? Well, not very well, at least a lot of them. A lot of them have come out this year, except they've also failed this year, and so have removed themselves from the ranks. And many others have encountered problems with their design in the course of launching. And this is maybe best exemplified with this graph of algorithmic stablecoins that are launched this year, with most really failing to maintain a peg in the long run. So this talk is going to focus on this non-custodial side of stablecoins, and also DeFi more generally, on sort of like finding what are the fundamental design problems that need to be confronted in how do you actually design these things well. And we'll see that there are three main design problems here, one called technical security, one called economic security, and a third called economic stability. And then we'll walk through a bit of our work beginning to explore this rich area. So we'll draw from the work here with many great co-authors. And I'll put these slides out publicly later so that you can sort of get links to all of this work if you want to dig deeper. So before we really dig in, let's go through just on a surface level, what does a non-custodial stablecoin look like? What are the different parts that come into play? And this is drawing back to those different dimensions that you were seeing in the earlier chart before about all these different design possibilities of non-custodial stablecoins. So one of the most important first parts is that you have some sort of collateral value or some sort of value backing the system. And this can take the form of exogenous collateral, endogenous collateral, or implicit or really no collateral. And the idea here is making a distinction about how does this collateral behave and how circularly is that value with the health of the system itself. And then there's another category here of sort of a role of risk absorption in the system. If you're making a stable coin, somebody is absorbing this price risk in some form. And so there are a few possibilities here. You could have an equity type position that is absorbing risk. You could have agents coming into the system and deciding to individually absorb risk. And then you could have the protocol itself trying to absorb the risk. And then there's another function here of actually issuing the stable coin. And here you could have this plugged back in with risk absorption, have it be sort of agent-based deciding the issuance. You could have it be algorithmic. And then there's also sort of this like algorithmic deleveraging process that may be happening in many of these systems behind the scene. And we'll touch on this a bit further in some of the later slides as well. And then you have sort of connecting in with stablecoin holders who are sort of the actual end receivers of this issuance process, people who actually want to hold a stable asset. And then you also have sort of needs for governance and price feeds. Governors here sort of like setting different hyperparameters of the system over time, and price feeds actually telling you what is the real world value of this collateral that's backing the system. And then behind the scenes, you have miners who always have the ability to censor or reorder transactions. And so from all of these different pieces, you can sort of see some areas where new risks and attacks might emerge. And this is what we'll kind of be focusing on in the rest of the talk. But there are sort of areas where there's deleveraging risks, there's price feed and governance manipulation risks, there's sort of minor extractable value risks that are coming into play. And then more generally, you could just have bugs in how all these things are implemented. And these are things that are not incredibly well understood today. So this brings us to what are the actual fundamental design problems that we want to be tackling to understand these sorts of systems. And one of these is technical security. And by technical security, I mean that there are sort of exploits that are possible, that may be possible, and these exploits are atomic and instantaneous. They're implementing sort of technical structure, and because of this atomicity, they're kind of risk-free. And then there's economic security, and this is a little bit different than technical security. It involves manipulating some equilibrium over some time period, and because it has to be over some time period, it's not risk-free. And then if you sort of have the system secure from a security perspective, you can move on to thinking, okay, is this system actually economically stable? Do the incentives lead to the stablecoin actually having a stable price? So let's start by tackling technical security. So why is this risk-free? So it's risk-free because the outcomes of these sort of exploits are binary for the attacker. Either the attack is successful and they receive the profit, or it doesn't happen actually because the transaction is reverted and they only pay sort of the nominal gas fee. And there are some good examples of this. MEV that is atomic fits into this category. Sandwich attacks commonly fit into this category, as well as reentrancy and logic bugs. And the good news is that at least over the last a couple of years here, these are much better studied than they used to be, at least. And there are some good ways to begin addressing these, such as through program analysis and formal methods to sort of specify the protocol itself and make sure that it's actually behaving technically in the ways that you want it to behave. And some good examples of this have also come up. In stablecoins in particular, there was the Origin Dollar flash loan exploit. And then there are also a bunch of lending platform examples recently. So how does this compare with economic security? So if you remember, economic security was supposed to mean sort of this manipulation of equilibria over some time period. And so really, you're sort of like taking advantage of, the technical structure. There may not be an exploit that's possible instantaneously, but if you exploit various properties of these markets that come up over time, this economic equilibrium of this market, then you may be able to sort of exploit the technical structure in lieu of through exploiting the economic equilibrium. And this is not risk-free for the attacker because there are tangible upfront costs. You have to actually do this market manipulation before you can profit. And it's not atomic, so you can't. It's not like their transaction gets reverted if your attack was not successful in the end. And this means that there's a real possibility the attack is not successful, and you could also sort of misestimate the market because you sort of rely on a model of the market to see, can you actually perform this manipulation profitably? And so these things are much less studied. And they include things like governance extractable value, what we'll call GEV. They also include certain types of MEV attacks, specifically things around reorg attacks. And then they also include market manipulation exploits. And fundamentally, to address these sorts of problems, we really need economic models of how these systems and agents work. And so we can't just do a program analysis, because the program analysis would also have to build into assuming some sort of actual economic model of how the markets work. And so let's walk through a couple examples just to illustrate this. One illustration, which is not a clear exploit, but does nicely illustrate what's possible, was in November 2020 in Compound. And Compound takes its price of DAI from or it did at the time at least, from Coinbase. And in Coinbase, there was either manipulation or some sort of market phenomena that occurred where the price of DAI spiked to $1.30 instead of $1 over just a 15-minute time period. And because of this sort of being recorded in the Compound price feed, it triggered a very large amount of liquidations in Compound. And why this could have been an exploit, or why you could design an exploit to take advantage of this, is that the liquidations in Compound, if you're performing those liquidations, you get an arbitrage profit. And so if you can actually manipulate this DAI market to trigger these liquidations, you can potentially get a very large payoff. And this is essentially what then occurred later this past year in May, where it was a clear exploit in Venus, where essentially the same sort of thing was happening in exploiting their market for XVS collateral. So let's move on a little bit to talking about sort of like how we're helping to fill in this area of economic security. So we begin by formulating some of these economic attacks. So we express some market manipulation attacks around liquidations that can also lead to minor extractable value. This is coming from our Instability for the Blockchain paper back in 2019. And a variant of this later occurred in DAI, actually on Black Thursday, and using mempool manipulation. And then we also formulate some potentially tractable, what we call forking models, to be able to model out these like MEV-based reorg incentives. And this is coming from our Stablecoins 2.0 paper. And then we also formulate this new area of governance extractable value, what we call GEV. And this separates into two main types. One type is what we call short-termism, essentially the ability for governors to make short-term decisions that maybe lead to short-term profits for them, but maybe are not in the interest of the long-term health of the protocol. And then also potentially outright malicious governance attacks, such as rug pulls or really indirect rug pulls. And so we begin sort of like addressing this sort of area by formulating some first models for modeling these incentives. And these are based on capital structure models where we incorporate this idea of a price of anarchy. So in other words, if you're making a truly decentralized system that does not have the protections of the legal system, which the traditional financial system does, then you're adding in this tangible price of anarchy because the governor's incentives need to be aligned without that outside legal system to play a role. And one of the problems that can arise here is that honest incentives around sort of like the intended cash flows in these systems may not be enough to really incentivize these governors to make the best decisions for the protocol. And this leads us to an impossibility conjecture about how some of these systems are designed today. And this impossibility conjecture is best illustrated with an analogy. So you would consider a bank, and if this bank is unsecure, if its equity value, let's say the value of its stock, is less than 2 times its assets under management or its deposits, if you're depositing into your bank, then it's quite obvious that no depositors would choose to participate because it's essentially their responsibility, if they want to participate, to be boosting up the bank's equity value to something just too enormous to make sense. And this is coming also from our Stablecoins 2.0 paper where we formulate these first models. And then we also come across a potential solution to this in one of our recent blog posts. And this is formulating what we call an optimistic approval mechanism that can potentially bypass this impossibility. And this mechanism, the idea is it gives users the option, so in this case, stablecoin holders themselves, to veto governance changes to potentially better align the incentives in the system, which is coming from our blog post called Governance Extractable Value. It's also being incorporated into a paper soon. And the basic idea here now is that you change the setup of the system so that if the governors are planning an exploit and actually perform it, then rational users, at least, will choose to veto this change, or at least have the possibility to. And the effect will be that the attack isn't performed and the system is only worse off for the governors because less people want to participate because they see malicious governors. So these are the ideas of technical and economic security. And in the rest of the talk, I really want to focus on this last topic, our work on economic stability. And this is kind of asking the question then that like, after you know that the system is secure in terms of how it's designed and how the incentives are set up, in terms of can you exploit the system and steal collateral, so to say. But taking this for granted, are the incentives actually set up so that like the issuance process in particular, does it lead to actual stable outcomes for the stablecoin? How likely is it that the stablecoin is able to retain its intended peg? And one of our main results here is around characterizing deleveraging spirals in DAI. And this is coming from 2 of our papers, Instability for the Blockchain and While Stability Lasts. So before getting into these deleveraging spirals, let's talk a little bit about how these leverage-based stablecoins like DAI work. So it's parallel to a CDO structure. And in this sort of structure, there's a portfolio of underlying assets. And then you've split this portfolio into two tranches. There's a junior tranche, which is intended to be more risky, and a senior tranche, which is intended to be less risky. And now if there are losses that are incurred, they're borne first by the junior tranche, and the senior tranche is intended to be protected. And this is parallel to these leverage-based stablecoins like DAI, in that the junior tranche is this risk absorber sort of role in this stablecoin. The CDPs in DAI, and the stablecoin holders are the senior tranche, are intended to be protected from price fluctuations. It also has this addition of a deleveraging process, which tries to make this the CDO-like structure into a perpetual instrument. And so the idea is that if there are enough losses that are incurred, then you try to downsize the actual supply size of the system and supply of DAI in this system, so that there's always sort of enough of enough of the junior tranche to be protecting what's left of the senior tranche. And so in these two papers, we've been modeling the price dynamics of these systems. And as kind of clear, but maybe is worth making explicit here, in the original DAI system, this supply is determined in this leverage market sort of way. So you have these CDPs who are this fulfilling this junior tranche risk absorber sort of role. They're coming in, providing collateral in say ETH, and deciding to leverage in that ETH. And so the DAI they actually create is through their leverage decision in how much they want to borrow against that ETH, which is importantly a very risky decision. And so to be conservative, they may not borrow up to the full limit, which is commonly what happens. And this leads to an endogenous price of DAI in this system, actually, because you don't have this guarantee that the supply is actually equal to demand at $1 price. And so you may actually have supply equal to demand at different prices than $1 at certain times. And this also means that the traditional financial leverage models don't really apply in this context because they don't have these sort of feedback effects built in. And so we developed some models that help to characterize these systems, and they lead to what we call deleveraging spirals, which are essentially short squeeze effects that also amplify collateral drawdown. And it leads us to find sort of stable and unstable regions for these systems and important consequences. So to basically set up this system, there's a collateral constraint, and I'll sort of breeze over this a little bit, but it is made formal. There's a decision then by the stablecoin to decide the stablecoin supply by this CDP speculator, and it takes into account this potential liquidation effect that can occur. Because if the value of their collateral falls too quickly, they may be liquidated in the system, or they may voluntarily liquidate themselves to deleverage. And in doing so, they can affect the actual market for DAI. And this leads to this deleveraging sort of effect. So basically, if there is a liquidation in the system, it means that some of the collateral is being used to buy back the supply and reduce it, which has an upward effect on price because now the demand is not really in line with supply. And this is because you have to be buying this DAI off of the market using this collateral. And the price is appreciating because you need to be bringing demand back in balance with supply. But this can lead to an actual second liquidation because the price of DAI is higher. And if the second liquidation occurs, you actually need more of the collateral to be consumed to actually be reducing supply, which has the effect, again, of increasing price further, which is what is needed to bring demand back in balance with supply. And this can happen sort of circularly in a spiral, and is actually what happened to a large degree to DAI on Black Thursday, which was one of its biggest crises and sort of shaped the space of leverage-based stablecoins going forward. So this led to some realizations that you may not have a stable region if you don't have sort of like positive expectations around these collateral types, and a seeming contradiction that you really want a decentralized stablecoin, but you can only make it fully stabilized by adding uncorrelated assets, and these are currently custodial. And patching this has been a major topic since Black Thursday. And there's been several attempts to do so. One is Maker, which incorporated their peg stability module, or PSM. And the idea here is to set up this, what's basically a primary market for stablecoin, where for DAI, where you can come in with a USDC and you can mint a new DAI by depositing that USDC, or you could take a DAI and redeem it for a USDC. And this has the effect of adding USDC custodial risks, unfortunately, into Maker. But at the same time, in DAI's most recent crisis, this past May cryptocurrency crisis, we did not see the same sort of effects in deleveraging spirals occur because of this PSM effect. But we did see essentially the volume of PSM really growing, and now it's actually 60% of the DAI supply is actually backed by USDC through a mechanism like this. There's also Ariah, which has been incorporating negative rates to sort of like reshape the incentives in this in these settings, and this leads to some questions around like what is the equilibrium participation if there's expected to be negative rates for long periods, and also it doesn't really address liquidity in these systems, and so what is actually the liquidity shape going to look like? And then there's also stablecoins like Liquidity, and also something that we suggested in our 2020 paper that have made these sort of dedicated liquidity pools for handling crises. And this actually performed fairly well over this last May crisis as well. Initially, there were a lot of redemptions in Liquidity at the start of the crisis, potentially because it's a new stablecoin and this was its first crisis, and redemptions is a feature of the Liquidity design. But then the liquidity pool itself, what they call the stability pool, was really able to absorb the shock over time. But this had the effect really of postponing the shock and really smoothing the effects, but still having this sort of like price appreciation short squeeze like effect realized. And then we also have a kind of a generalization of the PSM mechanism, which is kind of our next topic, which is going to go into algorithmic stablecoins. And this is something we're working on around reserve-backed primary markets. So with that in mind, the rest of the talk will sort of focus on thinking about algorithmic stablecoins and how would you design sort of like autonomous primary markets for these systems. And this is coming from a paper that is not released yet, but will be released very soon on sort of the design of this sort of a primary market. So before we tackle that, let's run through a little bit of what actually backs a currency peg. So there are two main sources of value that actually back a currency peg. One of them is you have some sort of asset backing. And this is a tangible sort of thing. You can actually look at these assets are worth this amount on this balance sheet. And then you also have some degree of economic usage, which is an intangible source of value. And it's essentially saying there's a reason to be holding these currencies. And it is you need this currency to unlock access to this particular economy. And if this economy is of a particular size, then there's some real value to sort of coming into this currency as a holder. And then if you have a $1 target for this sort of a currency peg, if there's sort of enough of these two sources of value backing it, then the peg can be sustained. But now if you have a shock to one of these sources of value, for instance here to asset backing, then it actually shifts how much value you have, and now the peg may actually break. And I want to stress that this is like a highly simplified sort of setup of this sort of a currency peg. You can read more about a precise model in this paper, which is quite good. So now what actually backs algorithmic stablecoins? Well, in these systems, you really start off with no native usage. There's no real economic usage in the first place, but some of them often try to be underbacked at the beginning. And so you really have this no economic usage, and for this reason, the peg often breaks. And then you also have a question of what are these actual assets that are backing the system? In some cases, this is essentially a senior shares system, and the value of these are endogenous so-called equity shares. And the problem with these is that their value is quite circular to the health of the system. And so you may have a setting where right when you need these assets the most, they decrease in value because the system is in distress. You also have systems, warning. Thanks. You also have systems like Basis, which have nothing here. And then you have another category of reserve-backed stablecoins where there's some portfolio here. So with this in mind, one useful way to categorize these stablecoins is first ask the question, the user coming into the system, they're paying $1 for a new stablecoin if the system is working, and where does this dollar actually go? So in one case, it goes to the pockets of stakeholders. In another case, it goes to partly to stakeholders and partly to some reserve that's backing the system. And in a third case, it's going to 100% reserve backing. And then the question is, what kind of happens to this in a crisis? And on this side, there's sort of no value retained by the system. And this is what sort of many basis type systems are essentially doing. In another one, you have some small reserve backing, but it's inherently smaller than sort of this 100% reserve backing. And so we end up seeing a lot of problems with many of these systems because they're essentially handing out a lot of the assets that could be used for stability to stakeholders in the system too early. And there are a couple other dimensions that are worth considering also. One is, again, the composition of the reserve, and another is sort of like how does the protocol actually maintain liquidity? And this is kind of our final point of discussion here, which is around how do you design algorithmic primary markets? And so here, this is essentially saying, how does the protocol actually maintain its liquidity? And it makes this primary market, which is essentially responsible for minting and redeeming. And this primary market has a redemption curve, which is a price of redemption as a function of the system state. And a key factor is how are these redemption curves designed? What do they look like? And they could look like on here, plotting price versus this amount of redemption. You could have all liquidity at $1, or you could have various degrees of curvature to these sort of curves. And in the basis case, you essentially have flat at 0. And so we've seen that doesn't work. I don't really have time to go through all of these case studies, but USDC USDT essentially has a flat curve at $1, but it has other issues. There was recently an issue with Fei, and you can understand it really in terms of implicitly having a bad shape to this redemption curve, which then led to sort of like large redemptions and the inability to handle those redemptions. And then you have seigniorage share systems, where the problem is really that the value of this volatile endogenous asset could really change depending on the health of the system. And so you have sort of like liquidity at $1 up to a point, but beyond this point, the liquidity may be exhausted and you may be left with 0. And a recent example of this is sort of the Titan and Iron debacle of the Iron stablecoin. And then we have some work, which I also won't have too much time to go into here, sort of designing how do you design these sort of markets in a more fundamental way with desirable properties? Some of the problems with the current space is that they're very ad hoc and really end up using governance to make quick fixes in crises. And that sort of motivates us to actually formulate the desirable properties and formulate a way to achieve those properties. And this is in our upcoming paper, sort of designing our gyroscope primary automated market maker. And we've designed it in a way that sort of like it behaves in a way where there's liquidity up to a point, but there's sort of circuit breaker protection and achieves a nice sort of like bounded loss for participants of the protocol. And so this is like some of the main properties here that we want. Bounded loss for the protocol and redeemers, in particular that reserve assets can't be depleted. An idea of path deficiency so that there's no incentive to subdivide trades. And also, importantly, that's efficiently computable on chain. So that really brings us to the end of the talk. The important takeaway really is that like these are sort of seeding the stablecoin and DeFi design problems and models that might be useful going forward. And if you're working in the DeFi space, you should think carefully about which type of problem you're tackling and which sort of models you really need to tackle it. And thank you for listening, and feel free to ask any questions.